Imagine you just started your business. You've hired your first employee, you're paying them fairly, and then the tax letters start rolling in. Suddenly, you're not just a business owner, you're a tax collector, a record keeper, and a liaison to the Internal Revenue Service. In the world of payroll, every paycheck is more than just a payment, it's a legal obligation. Employers are responsible for collecting and submitting income tax, Social Security, Medicare, and unemployment taxes on time and accurately. And that's where things get tricky. A small mistake, like a miscalculated deduction or a mismatched W-2, can trigger IRS notices, penalties, and a whole lot of stress. When I worked for a company that had merged with two other companies, several payroll tax returns were filed under the incorrect employer ID number. It took quite some time to figure out what had happened. The tax notices started coming in, and then it took nearly a year to fix it all. That's why it's important to get it right from the start. In this session, we'll walk through who pays what, why these obligations matter, and what payroll professionals must do to keep everything in compliance. Let's break down the division of payroll responsibilities because it's important to distinguish who's responsible for paying the tax obligations. Some taxes are shared, some fall only on the employee, and others are solely the employer's responsibility. Understanding the split is important for compliance and for planning payroll costs. Here's a quick breakdown. Shared tax obligations, meaning both employer and employee carry the tax burden, are Social Security tax, Medicare tax, and in some areas, local occupational taxes, and rarely, state unemployment tax. Employee-only obligations are federal tax, additional Medicare tax, state and local income taxes. Not listed here, but voluntary deductions would also fall into that category. For example, 401k, insurance, union dues, and charitable contributions. Employer-only obligations are FUTA for federal unemployment, SUTA, state unemployment in most cases, and workers' compensation insurance. So once a paycheck is issued, it's the employer's job to ensure all taxes are calculated, withheld, and submitted properly. This includes reconciling withholdings to what's paid and reported on tax forms quarterly and annually. Even after an employee leaves the company, tax obligations may continue. Did the former employees receive stock, deferred compensation, severance? These require reporting sometimes even years after employment ends. One of the major categories of shared tax obligations is for FICA. Do you recall that FICA stands for Federal Insurance Contributions Act? It funds Social Security and Medicare. This is one of the few payroll taxes that's a true 50-50 split between employer and employee. And Social Security tax is 6.2% each, and Medicare tax is 1.45% each. In addition, high wage earners pay an additional 0.9% Medicare tax surcharge, but that part is not matched by the employer. Let's look at an example. Marty earns $36,000 annually, paid biweekly. That's $1,384.62 gross pay per period. The Social Security tax is calculated by multiplying the gross wage of $1,384.62 by 6.2% for $85.85. Marty has that amount withheld from their paycheck, and $85.85 is paid by the employer for a total of $171.70. We follow the same steps for Medicare tax, which is calculated by multiplying the gross wage of $1,384.62 by 1.45% for $20.08. Marty has that amount withheld from their paycheck, and $20.08 is paid by the employer for a total of $40.16. Together, that's $211.86 total FICA owed for just one paycheck, half from Marty, half from their employer. Payroll professionals must calculate, withhold, match, and submit these amounts for every employee every pay period. No rounding errors allowed. Unemployment insurance is another key payroll obligation, but it's an employer-only tax. FUTA, or Federal Unemployment Tax Act, helps fund the administration of unemployment benefits, not the benefits themselves. It applies to the first $7,000 of each employee's wages annually. Here's the math. Standard FUTA rate 6%, but there is a caveat. Employers who pay their state unemployment SUTA taxes on time can usually claim a 5.4% credit, dropping their effective FUTA rate to 0.6%. That's a max of $42 per employee per year. But watch out, if a state borrows from the federal government to fund unemployment and doesn't pay it back, that state becomes a credit reduction state. That means the employer pays more FUTA. Here's an example from our textbook. Snowborn Inc. in Montana has 178 employees. All earned more than $7,000 in 2025. Since FUTA applies to only the first $7,000, we don't need to track exact earnings. 178 employees times $7,000 times 0.6% equals $7,476 in FUTA tax due. I recommend that you always track year-to-date earnings. Once an employee hits $7,000 in taxable wages, the FUTA tax no longer applies for the rest of the year. Now let's talk about SUTA, state unemployment, and workers' compensation, both key employer-paid obligations. Unlike FUTA, the SUTA rate varies depending on the state's rules and wage base, the company's industry, and the company's turnover and layoff history. This is called the experience rating system. Employers with fewer unemployment claims often get a lower SUTA rate. For example, construction company A has seasonal work and frequent layoffs. Its SUTA rate is 4.54%. Professional services firm B has low turnover. Its rate is just 3.28%. In California, the wage base is $7,000 and the rates range from 1.5% to 6.2% in 2024 and remain unchanged in 2025. That's a wide range, right? But employers have some control over the SUTA rate. To keep rates low, employers should minimize turnover, carefully document all separations, contest inappropriate claims, pay SUTA on time, and review state SUTA notices each year. Now let's talk about workers' compensation. This is not a tax, but it's a legal requirement in most states. It's an insurance policy that covers medical costs and lost wages if an employee gets injured on the job. Premiums vary based on the risk level of the job. An office clerk costs far less to insure than a roofer. Accurate job classifications are critical. Misclassification can lead to audits and penalties. I hope you enjoyed this video about employer obligations for payroll and found it to be helpful.